Mr. Janumahanti Lakshmana Rao, who's the Chairman and Managing Director of Moldtek Packaging, joining us this morning. Mr. Rao, let me first start off by understanding what trends are playing out. Growth hasn't been the best for you over the last 3 years. Are you expecting a meaningful or a significant pickup in growth H2 or FY27 at all? Give us that indication first to start off.
Good morning. I've been watching your analysis, couple of errors I noticed, but anyway, apart from that, the growth is picking up this year. You have seen the first half, we have 10% overall volume growth, and in terms of revenues, it is a 16% uptick from 780 crores. Probably we may end up this year close to 900 crores, which will be almost like 12 to 14% revenue growth. This is something which was not there in the last couple of years or 3 years, because basically last 3 years we are building up capacities. We have built up 3 plants at Panipat, Cheyyar, and at Sultanpur here in Hyderabad, and the 4th one at Mahad is also is being supported from Satara, but it is also under construction. So all these plants investments were being made in greenfield projects. That is what is impacting ROC as if because the capital has increased much higher than the sales growth. But it will be catching up in these couple of years. Already we are seeing a 10 plus growth for this annual year ending 26 March. And from there onwards, I'm positive that our growth will be in double digits, because not only the 3 plants are now up and running, even the extra facilities that have been created both at Panipat, Cheyyar, and even at Satara are now being utilized by ABG in a reasonable manner. The capacity utilization is slowly creeping up. It was only 62-63% last year. It's now coming close to 69%. And I think the whole year we will cross 70. And next year we can look forward to our best capacity utilization, which is around 75 to 80%. Beyond that, it is not possible in a packaging industry, which is subjected to seasonality, especially monsoons and winter season. The demand for some of our products dip a lot, causing some seasonal variation in our performance.
So going forward, Mr. Rao. Fair point. Fair point. Apologies for interrupting. Talk to us also about what is it that you disagree with? What is it that you would want to change with regard to whatever I have said about the company? Please tell us.
No. The cash flow statement, when you are showing, yes. If you go back to the slide, I think there is a mistake in that calculation.
Okay. All right.
Here the cash flows. What do you mean by cash flows of 25 is 110 is correct. The year before that?
Okay. Sir, we'll get to that. We'll get to that in just a minute. Understood. Okay. Sure. Okay. So, sir, there's going to be a ramp up with regard to capacity. I understand that. Talk to us about what this does to top line, right? You've seen very, very mild growth over the last 3 years. What next with regard to top line growth? Where does it go in FY27 as you hike your capacity utilization beyond 75% is what you are aspiring for?
Yeah, we will be definitely crossing the 1,000 crore mark, because we'll be hitting close to 900 this year. That is up by around 12 to 13%, or maybe 14%. And going forward, it may even ramp up from next year, because pharma and also the Panipat plant is started manufacturing both capex and thin wall products, that is food and FMCG products. That capacity utilization also will start picking up from February onwards. 2 sets of machines were set up, and now that will become 6 sets by March, and that will start adding to the numbers. So these molds are what are, sorry, I have to just mute it.
Sure.
Yeah. So yeah, the numbers in pharma are also shooting up. As I said last year, we are about to meet the projected turnover of 35 crores for the current year, up from 9.5 crores or 10 crores we did last year. But of course, that kind of 3 times growth is not possible. But we are looking at least a 50% growth in pharma packaging which will touch around 34-35 crores this year, and we will be aiming at 50 to 55 crores for the next financial year. So capacities are already built for that. Even the minor
Sure.
adjustment in storage space is also ready. So that is another big addition that will come up in the company's operations.
Understood. So you hit 1,000 crore in terms of top line likely by FY27. I'm trying to understand what next. So if I look at the 3-year picture, you will be at 75% capacity utilization. You've described the fact that it's a seasonal business and therefore capacity utilization creeping above 75 will be difficult anyway. So therefore, what's in store for the next 3 years? How do you see the growth part there? Is there additional capex required?
There will be brownfield expansions required continuously because some of the old machines need to be replaced and some of the balancing equipment in pharma have to be added. Looking at the traction, what we are getting from big pharma companies in the last 1.5 years, it's very heartening. And those capacities need to be added. One good thing is land and buildings won't be much added in the next 3 years for sure. Only the small construction activity at Mahad, which is already underway, will be completed by hopefully March, April. And thereafter, there'll be little addition to the land and building, which are non-performing assets. But there may be some additions of machinery, certainly in pharma, where we need to add capacities as we are trying to reach 100 crores turnover within the next 3 years. So there will be certainly some more investment of, say, 20 to 30 crores every year, and replacement of machinery to the tune of around another 20 to 30 crores. So probably our capex budget, which has been running above 120 crores for last 4 years per annum, will come down to 60 to 70 crores in the coming 3 years. But that will still create a growth momentum anywhere between 12 to 14% in the next 3 years is our projection.
Understood. So currently you're penciling in maybe from the current base hitting 1,000 crore by FY27 and thereafter maybe 12 to 14% growth. So that's the kind of glide path. Talk to us about FY26 in particular. What has happened in H1 and why is it that you haven't guided for a pickup in demand in Q3? Why are you expecting that to come in Q4? What's the rationale there?
See, basically, there are two things drive our seasonality. One is Diwali, that is festival season, and the second is the monsoon. This year, extended monsoon, which started right in the beginning of May and went on till end of October or middle of October, has impacted the demand for paints, demand for other products like ice creams and curds, yogurts, and all frozen products. So those constitute sizable amount of our product sale. Paint constitute almost 40-45%, which has also dipped in the monsoon time. And ice cream and yogurts constitute almost 10 to 15% of our sale. So their consumption has come down right from May itself. In spite of that, I'm very happy to see that we have made a 10% growth in the H1. And in the H2, the Q3 started slowly. Soon after the festival, there was a lot of the early Diwali also makes the festival time little difficult period for consumer goods, consumption. But fourth quarter looks better because the pent-up demand for the paints I see is improving in November, December onwards. And going forward, that pent-up demand will definitely come in because of the CST cut, not only in paint, but also consumer goods. And there are a couple of good wins we have in FMCG products for which the molds are getting ready. They will be going into production from Feb onwards.
Sure, understood. Talk to us about raw material prices and the impact of that on your EBITDA margins. You've been very steady where EBITDA margins is concerned. I have to give you that credit. What helps you maintain this kind of margin despite raw material prices being slightly choppy, if I can call it that?
In fact, raw material prices have been softening over the last 1 year, 6 months at least. We don't get much benefit out of it because we pass on the pricing on a monthly or quarterly basis to the client. So either the raw material goes up or down, it has very little impact on our EBITDA. What improved the EBITDA is we have started integrating the facilities. Now in Hyderabad, we used to have 5 plants. Today it's come down to 3, and we are in the process of merging one more small plant into Sultanpur. Thereby, operations, integration, and cost reduction, better, a movement of goods would come down and costs will improve. Will decrease. So that is what is we are seeing in Hyderabad plants. But better utilization coming forward in the next couple of years is going to definitely improve the EBITDA, mainly due to pharma, which is a high contributor to the tune of 100 plus rupees per kg compared to our average of 40. If it start building up to 10 to 15% of our turnover in the next 3 years, that can really be a good value add to our bottom line.
Can you do 15% in 3 years from pharma?
10 to 15% is definitely possible. We are aiming at 100 to 120 in 3 years.
And where would that take your margins, sir, if I may ask?
See, if we achieve that number at, let's say in 3 years, we reach a number about 100 to 120 crores, it will certainly pull up the EBITDA margin by 3 to 4 rupees overall EBITDA margin. And if you also notice last year, we were only at 37.6, and this half year we are at 40.6 EBITDA. So that is the kind of EBITDA improvement we can still look forward to once the pharma reaches a sizable contributor, and also better utilization comes into all these greenfield projects where we invested in the last 4 years. I'm sure Panipat utilization will go beyond 70 next year, 70, 75. Even Cheyyar is going to reach, because we have moved a part of Gulf demand to Cheyyar, Gulf lubricants. So the capacity utilization is going to improve. And bringing those companies under one roof in Sultanpur is bringing a lot of cost reduction and better output.
So if I'm doing the math right, you'll be at around 1,000 plus crore in terms of revenue. You'll do around 200 crore of EBITDA, and you're guiding for capex of only 60 to 70 crore annually. Do you therefore utilize the balance cash to repay your current debt? Is that the way one looks at it?
Yeah, it can be used to reduce the debt, which is not very high, considering the debt equity of 0.33, which is very, very modest. That too inclusive of working capital. Our debt equity ratio is just 0.33. Which is very low compared to the industry average. But in spite of that, those funds, whichever overflowed, would be used for either expansions in other areas we may get into. For example, recently we have signed a MOU with Vibe UK, who are pioneers of pioneering company in closure, industrial closures has started this. And that team is going to give us their patent rights and designs for some of the industrial closures, which they will sell in Europe and USA. So that is another new segment we are starting now. I am not going to say that in the next few quarters itself, it is going to add big values. But by 27, 28, we will see considerable numbers. Already 3 product designs have been shared with us last week. And we have to come out with the feasibility report and making the trial molds. And probably in 4 to 5 months' time, these products will be marketed by them in Europe and USA for the clients with whom they have been associated for more than 30 years in this field. So these are the new segments we are trying to get in. It will be useful to use the idle capacity to some extent. But once these numbers reach something like 30, 40 crores per annum, then we need to add few more machines, but not much space, because they are small caps and closures of high value.
Sure.
Won't be required huge space.
Sure. Mr. Rao, it's been a pleasure speaking. It's been great understanding the forward-looking expectations that one can have from Moldtek Packaging. Thank you so much for joining us this afternoon. I'm sure that gave viewers a lot of food for thought. And viewers, completely out of time on this edition of AAYC. Stay with us here on ET Now. More action to follow.